Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris Rapeseed, Winnipeg Canola, and Malaysian palm oil.
Hello and welcome. Before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of the patterns, levels, analysis or any related items on these, my charts. This is all my original work, as I think you deserve to have that. So with that, Paris Rapeseed. Since the low in mid-March, where we saw the fall ending with a hammer pattern, we've seen a V-bottom followed overall by prices, for the most part, very gradually moving high in what I initially thought might be a possible ascending triangle pattern, but which became an ascending wedge pattern. The lower trend line for both is the bright red mid-March to date, breached a number of times and repaired and breached again last week and this week. Uptrend currently at 483 3/4. Initially, I chose not to draw a new trend line on the top side, but instead rely on two previously highlighted features. The first is the fairly flatlining long moving average, currently at 496 even, or the dark blue neckline extension, currently at 498 3/4, to the April to August 2024 head and shoulders top. Now, we've had attempts higher over both of these over most of mid-May, but we only finally had a really concerted attempt higher 8 weeks ago. Now, this initially looked good, but a subsequent gapping changeover move lower put the market back down within the body of the ascending wedge pattern once again. The fall was slowed by the bright green, very shallow neckline extension, currently at 481 1/4, of the August to September 2024 head and shoulders top. A neckline that had acted as a resistance back in April and a sort of support at the change from May into June. And interestingly, we saw the last 2 weeks acting as support. Further support was from the mauve medium moving average, currently at 482 3/4, and I suppose in the past the green short medium moving average, currently 486 1/4, though this is now capping the market over the last 3 weeks. However, last week and especially yesterday, we have seen significant breaches lower, verging on breaks being lower, below the broken bright red uptrend, below all the moving averages, and below the bright green neckline extension. Further support below is now at the congestion zone, which we have now entered between the bright green neckline extension above and the 50% Fibonacci line of the May 23 to January 25 move down at 467 1/4. Quite a wide support zone, but it's still there. So, though we are trying low, we still do have this congestion zone below. Now, 5 weeks ago, I decided to lay out some potential targets topside for the ascending wedge pattern, though, as I said 4 weeks ago, and I quote, "I freely admit I have doubts about them and would consider some immediate retirement should prices drop down below that congestion zone below." End of quote. Thus, a primary target at X is up in the 421 even area, just above the congestion overhead that is in between 514 to 519.5, which capped prices 6 weeks ago. Plus a secondary hardest to reach target X1 is up in the 537 area. This latter one looks very hard to achieve until you realize that we have limited overhead resistances past the congestion overhead between 514 to 519.5, which capped the rise 6 weeks ago. Looking beyond that, well, it looks fairly quiet and empty right now, but first we have to get up there to see if this is true, and so far that is something the market has not seemed happy at doing. Prices have instead tested the downside, closing below the bright red lower trend line of the ascending wedge pattern for the first time 4 weeks ago. However, temporarily that may have been, but closing below it once again yesterday with the second lowest close overall since early May. This prompted my thoughts 3 weeks ago to look at downside targets, whilst for now maintaining the topside targets as prices were and are still within the congestion zone that's below, I've mentioned previously. So, 4 weeks ago I risked laying out some targets below to balance the upside ones. Thus the primary target X2 is down at 462 even, underneath the 50% Fibonacci line on May 23 to January 25 move at 467.25, but just above the late April low at 461 even. We also have a secondary harder to reach, much harder to reach, target X3 down at 433.5, a target that seems very out of reach right now. One final thing. 2 weeks ago I drew a purple mid-March to mid-July bullish shift pitch hook. It was very tentative, but we seem to wish to stay above the lower tine, currently at 481.80. However, this week that has proved not to be the case, with prices yesterday punching clear down and closing below the lower tine, which is currently at 471.75. As I said last week, and I quote, just keep a wary eye on this one, as it may become interesting, or it may become retired, or it may become morphed into a shallow bullish shift pitch hook for the same move, or, and this is something I noticed this week, part of the mid-June to date part that might become a possible bearish halfway hesitation. So caution. And that's the end of the quote. After this week the pattern will become retired, but I will still keep some of the possible morphing patterns mentioned that may result, in my mind, something for the future. Winnipeg canola. So after 2 weeks or so of relatively little happening, late last week we started to see a move down here, and it started with a weekly key reversal down last week, one of two in this commentary, the other being Bursa Malaysia palm oil futures. Now I'll speak more about that later on in my Malaysian commentary. Going back in time a bit, back to mid-May, we started to run in some serious overhead dynamic resistances, specifically a resistance I mentioned 14 weeks ago, and I quote, some generated congestion roughly between 723.70 to 735.20, plus a recent ascending wedge lower trendline extension, end of quote. I added to this list 12 weeks ago the neckline extension of the old August to October 2024 reverse head and shoulders continuation pattern. That's currently at 766 even. This one had been particularly good at capping the market as recently as 7 weeks ago, and also at the start of 6 weeks ago. We also had a gapping changeover lower 12 weeks ago. Prices have since tried to recover, but the initial rise in late May and early June was earlier tempered on approach to the overhead 50% Fibonacci line of the July 23 to March 24 move at 700.5, before finally breaking higher mid-June and filling in the changeover gap. All this was achieved from the ammunition gathered in the earlier drop down as we entered into June, down to the previous mid-May low in the 664.10 zone, which is coincident with the November 24 high, and the interesting 38.2% Fibonacci line at 665.70 of the same July 23 to September 24 move that the 50% Fibonacci line above had capped prices on, plus back then this not insignificant rising green short medium moving average, which is currently at 702 even. So all these halted a decline back at the turn from May into June. Now, as I said 8 weeks ago at the end of my commentary, and I quote, so what have we growing here as a pattern? Well, I'm not sure. But if I was to hazard a very outside, really outside idea, then I would look at the action recently as possibly a possible bearish cat's ears pattern, or less outrageously, maybe a double bottom, end of quote. Since then, well, we have seen a formation of the easier double bottom pattern during May and June, with a following on higher to reach both the primary and secondary topside targets of the pattern. However, 7 weeks ago, the market became capped once again by that previously mentioned neckline, dropping back down in a stepping motion down to below the green short medium moving average, as well as the 50% Fibonacci line of the at 730 back to levels we saw in early June, testing this week the lesser Fibonacci line at 678.40, as well as the mauve medium moving average, and that's important, that one is currently 683.5. I said 2 weeks ago, and I quote, it has still left us all somewhat rudderless with a possible topping action, but no definitive pattern emerging as yet, end of quote. Well, this rudderlessness, even if there is such a word, is why I doubled up last week's commentary based on the previous week. However, we might now be seeing something seemingly trying to move lower, with the first real move down below the rising mauve medium moving average, which is currently 683.5 since early April. My thoughts back then are still relevant now, as I said, and I quote, "We might still form some other pattern, such as a head and shoulders top, and I'll watch out for that, but for now I don't see any major pattern as yet, and for those who ask, no, I am not comfortable drawing fresh bullish Andrews or shift pitchforks just yet, as it looks like unstable ground right now. Just watch out near term on the top side. October to November 2023 neckline currently at 70, currently at 724.90. It might still have a bit of a bite, and that's the end of that long quote. Now I added to that last week, and I quote, also watch out for this rising mauve medium moving average below, currently at 683.5, as now is entering the frame, end of quote. And this rising medium moving average is the one we are testing today, and I hope we might get a sense of the true next direction should prices either overcome it or give way to it. Watch this space. Bursa Malaysia crude palm oil. Now to start with, as I've done for a number of weeks now, I'd look to the wide congestion area now overhead between 44.08 to 45.59. This was when I started looking at it some while ago, a bit far away, but it's been getting closer week by week. It was originally support, but is now resistance, and not only that, but longer term resistance. Next, there's the significant combination of the 38.2% Fibonacci line of the May 20 to March 23 move and the 50% Fibonacci line of the May 23 to December 24 moves, both very close at 42.74, capping the market for the last 3 weeks, plus this week. Now, it was previously joined, but is now separating away by the declining mauve medium moving average, currently at 41.15. This interestingly capped prices late 4 weeks ago and at the start of 3 weeks ago, but gave way under bullish pressure late 3 weeks ago, and we can look at it now as support. We also have nearby the lesser Fibonacci line at 42.39, though this now doesn't seem to be doing that much right now. The overall move higher here all started with the drop down and subsequent build up from the testing and breaching of the interesting dark blue neckline extension below, currently at 38.69, of the small late May to April 2024 reverse head and shoulders bottom. I said 14 weeks ago about this dark blue neckline, I quote, "This is one to watch on the downside, as it is the core of a large April to September 2024 congestion zone stretching from roughly 3750 to 4100, end of quote. This dark blue neckline extension became a key support, then a resistance, and now an interesting congestion point, all at the same time. Importantly, it caused prices to start to move higher, with what turned out to be, as I said 8 weeks ago, and I quote, a possible, if imperfect, bright red ascending triangle pattern formed over late May today. It is a small pattern, and I could regard the action as an attempted false break on the downside that so far has failed. False breaks coming as they do so far along the triangle and so close to the tip are not unexpected, and whilst I cannot as yet give definitive targets for either side, I can give an idea of the potentials involved. Thus, a true confirmed break higher over the bright red upper trend line will now have a primary potential of plus 209 ringgits, with a break below the bright red lower trend line will have a primary potential of minus 131 ringgits, with a secondary harder to reach potential of minus 298 ringgits. Since then, prices have stabilized over the bright red upper trend line and leading with those earlier numbers to having a primary target topside in congestion overhead. 4 weeks ago, the market reached up and opened over the primary target when it moved up over the mauve medium moving average. Then late 3 weeks ago, prices went further and reached the secondary target at 42.79. All this action since mid-May has led to the construction of a bright red mid-May to date bull channel, currently 41.98 to 44.58. That utilizes the breached but repaired lower trend line and a newly drawn upper trend line. What was interesting about this upper trend line is that it crossed over the flatlining gold long moving average, currently 44.10, in the middle of last week. And I said 2 weeks ago, and I quote, I will be very wary around that time, as we should see a significant move or even just volatility at that time. Well, I'm sorry to say we didn't see much of any of that last week, and there was a little, which was a little disappointing. But this week, well, we are set up today to make a weekly key reversal. This week. This is one of 2 weekly key reversals in this commentary, the other one being in Winnipeg Canola. Now thus, if tomorrow, so that's Friday, we close either over 42.58 or under 42.26, then we'll be on. Anything in between have a lesser outside weak pattern. Right now, we are looking at a possible outside weak pattern, I'm afraid, though we still have plenty of time to change that. However, in the meantime, the market still remains within the bright red bull channel, though we do have the flatlining gold long moving average now above within the same bull channel. Just remember to keep an eye on the gold long moving average when and if prices start moving within the bull channel. There is one other feature which I would like to discuss, and this came about because I was at the end of June speaking about it at a presentation at the Biofuels International Conference and Expo in Brussels, Belgium. It was and is to watch out for a key level from now until the end of the year. And that level is 35.99. So it's quite a way away below the market. However, if prices push down below 35.99 before the end of the year, which is still possible, then we would have set up the conditions here in palm oil to make that rarest of patterns an annual key reversal, with all the implications such a huge long-term pattern may bring. Please watch out for this, as it is important, and I'll bring you more details should we get down below there. Even though I know we today are many hundreds of ringgits above it. Just please bear it in mind, though we still have, as I say, many months of this year to go.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.